thanks. Right, so good morning, everyone. I'm going to start today with the dollar, and then we'll talk about ringgit, and if there's time, we'll talk about RMB and Sing dollar as well. And then if there are still other questions, you can put it on the Q&A box, and we'll get to it later. But I think I'll start with the dollar because, even though if you have other questions about other currencies, at least you know half of the exchange rate, which is the dollar half. So the dollar's view is, I think, quite divided in the market right now. For us in HSBC, our view is quite moderate. Like we think there's going to be further dollar strength, but we acknowledge that it's not going to be, like a very sharp rally. So we try to compare it to some historical examples, historical instances, episodes. For example, in this chart, we compare it to the last cycle in 2017, 2018, 2019. The reason why we do that is because that time was also a time when the Fed continuously hike rates and also did the quantitative tightening, shrinking the balance sheet. And the dollar actually really did, gain quite a fair bit during that time. And not to mention, there was also the backdrop of US-China trade tensions. And so there was global slowdown, there was risk aversion. A lot of these things benefited the dollar. I think our view is that, that is a useful template. But we're not going to see, we're not expecting the same type of magnitude in the dollar. So you can see also that, so far this black line, which is the dollar in the last couple of months versus the red line, which is the dollar in that 2017, 18, 19 episode, it's clear that, the direction is roughly the same, but the magnitude is a little bit different, right? We're not seeing that the dollar rallying that much. It comes down to, I think, positioning. So this chart, the gray areas show the dollars, the market's positioning on the dollar, like, whether speculators, whether asset managers are already holding long dollar positions. So I think a lot of the increase in the dollar in the 2018 episode was because we started from no positioning in the dollar to a rapid ramp up of the positioning in the dollar. And so that also corresponded, as you can see, this red line is the dollar itself, the dollar index itself is corresponded with this appreciation of the dollar. But this time around, we are already at, I wouldn't say peak dollar positioning, but we're already at a level of dollar positioning that is quite high. Obviously, it's not peak, right? Like you see in 2015, this is quite elevated. But still, we are we are definitely far away from zero. So the market is already long dollar. To put it simply. So therefore, there is limited room to further increase, even as the market keeps on pricing more and more rate hikes. So as Joseph already mentioned, the market's pricing expectations for the Fed rate hike has actually drastically changed, in the last few months. So this dots, right, it's actually the Fed's own forecast just in December, just 2 months ago. And over the last 2 months already, the market has really gone way ahead of these projections. So the way we see it is that there is limited room for rate expectations to rise further. Let me put it this way: the market is now expecting something like 6.5 rate hikes this year for the Fed. There are only 7 meetings, so there's very little room to push this further. So this might actually weaken the dollar, right? So as sometimes in the FX market, how rates affects is through 2 ways, right? One is the change in the rates. So if you're expecting this central bank to raise rates, that's that change that is you're focusing on, and that will push this currency stronger. So that was what we saw for the euro earlier, when some people think about how maybe the ECB, the central bank in Europe, can raise rates, and then this idea of that change in rates actually pushed the euro higher for a couple of weeks. But I think beyond that, there's also a time whereby you go from looking at change in the rates to the level of the rates itself. And I think that's when the dollar will start to shine, because as mentioned, there is limited room to push this change in the rates for the dollar, right? We are already at, peak pricing for the Fed this year. So, this is why the dollar is not exactly benefiting right now and year to date. But I think at some point in time, once everything is priced in for every central bank, then that's when you start focusing on the level of the rates. And here you can see, in terms of the level of rates, as the y-axis here, the dollar is actually, I would say, in the upper half of G10. Right? I mean, obviously, you cannot compare with some of the commodity currencies, which are naturally higher yielding, but it definitely will be a stronger, a higher yielding currency than all these European currencies and all these Japanese yen and European currencies. So from a carry perspective and from, like bond flows, etc., type of perspective, there's no reason to actually really dislike the dollar compared to some of these European currencies. So I think at some point in time into the second half of the year, beyond the first rate hike, then that's when we will start focusing on the level of the rates, and that's when the dollar will really start to be more supported. Another reason why the dollar will be supported this year rather than go through depreciation is because of this risk appetite. So, I mean, year to date, we've already seen the S&P, the US stocks, VIX index, go through a lot of volatility, and we suspect that this will just remain the case for the whole year. We've seen, stocks volatility on the back of inflation, concerns about how inflation may affect growth, may affect the chasing power, concerns about how the Fed's rate hikes, 6.5 rate hikes may, affect companies' balance sheets. And then more recently, there's also risk sentiment taking a hit because of the Ukraine crisis. And through all this, I think it's quite clear that the dollar remains inversely correlated with risk sentiment. So here we do like a correlation of currencies to the S&P, which I guess is our barometer. S&P is the US stocks index, to risk appetite. And this is just year-to-date observation. So we ignore the 2020 and 2021 observations. And you can see that the dollar is one of the few currencies that are negatively correlated, right? I mean, there are also other currencies here that are negatively correlated, although this does not mean that all of them are safe havens. It could also mean that these currencies are trading on their own themes and are just like agnostic to risk sentiment. For example, Thai baht is just trading on this idea of reopening, and so it doesn't really matter what's going on with risk appetite, things like that. But I think the dollar and the yen are clearly what we call safe haven currency. So no doubt that this, as long as risk appetite remains fairly unstable for the rest of this year, it is very unlikely for the dollar to actually really have a material sell-off. So on the back of this, then, what does it mean for dollar ringgit? Now, I would just point out that even though we expect the dollar to not depreciate, to remain supported, this has been the case since July 2021, right? You can see this black line here. This is the dollar, the broad dollar index. It's been rising since July 2021. But through this time, the dollar ringgit exchange rate has been in the range, right? So it hasn't actually responded to this broad dollar index rising. It's just sort of stabilized, moving sideways instead of moving upwards. So I think this is a good sign, right? But that being said, it could have been better, right? If you think about the trade balance, which Joseph already mentioned, breaking records, doing very well in both the commodity as well as non-commodity sectors, actually a little bit puzzling. Why is dollar ringgit moving sideways instead of falling instead, right? Because if you have such a strong trade balance, there should be a lot of conversion flows from dollar into ringgit and helping the ringgit to appreciate. From the terms of trade perspective, right, like Malaysia's export prices, you can see that it used to correlate quite well with the ringgit, but recently these terms of trade shot through the roof, but the ringgit has just continued going sideways. So this is one. So it's true that going sideways is better than moving up with the dollar index, but it could have still been better. The dollar ringgit could have fallen instead. I think a lot of it comes down to capital outflows, and it's capital outflows from locals. So here we can see, the deposits onshore in terms of FX deposits, and you can see it just basically has risen a lot since the pandemic started, since, BNM has relaxed some of these regulations with regards to export conversion, with regards to holding of FX deposits. It is now at a record high. And then apart from onshore FX deposits, we're also seeing like cross-border outflows in the form of, portfolio investments overseas and our overseas direct investments, and also some other type of investments that is very hard to capture, and we just call it errors and omissions. So these are the outflows that is recycling, all this capital, all this trade balance. We have a lot of trade balance, but it's just not being converted into ringgit and supporting the ringgit. So this outflows by locals, I think, is a big issue, and it remains to be seen whether this can be resolved. Like some of the theories that we have is that this outflows is related to, say, confidence about the economy, maybe to do with the pandemic, because last year was really a difficult time for Malaysian economy and the Malaysian government with regards to handling the pandemic. So maybe this year, some of these concerns would and this confidence issue would fade away, and so maybe there will be less hoarding of effects and less outflows, right? Not to mention, with US stocks, being so volatile, maybe there's really no reason to invest that much abroad this year. So there is some hope, I suppose, that some of these outflows this year would slow down and allow the trade balance to actually really matter for this currency. So that's one of the reasons why we see dollar ringgit falling. The other reason also, apart from the trade balance, is already is to do with the FDI. So FDI actually has surged last year, but the thing is that it's actually still an underestimate, I think, of what it could be. So this black line here is approved FDI in terms of the applications that Malaysia has already received, and the red line here is the actual inflows, and you see there's a huge gap, right? So it seems like it's definitely possible for this to catch up, and so for the inflows to actually materialize. So they've already applied, they just haven't actually put in the money. So yeah, there's this. So we're still quite hopeful that this FDI could further support Malaysia's current account core balance of payments on top of the trade balance. And then also there's this hope that maybe tourism balance, which was negative last year, could at least turn to zero or maybe even slight positive. So all these things work together and hopefully propel ringgit a bit stronger. Now, with regards to foreigners flows now, in terms of foreigners flows, I think this year we are a bit more hopeful on equity rather than bond flows, because bond flows has already recovered last year, right? So in 2020 and 2020, obviously it was still very weak. 2021, we've actually seen quite sustained bond inflows. And since, we have this view that BNM is not going to be in a rush to raise rates and follow the Fed, so this yield differential may not be all that advantageous for Malaysia in terms of bond inflows. So maybe we shouldn't hold too much hope here. But I think equity inflows is where we could actually see some support for the ringgit. So in terms of equity outflows, over the years, basically, actually even before the pandemic started, there have been consistent equity outflows, right? Like about 20 billion if you start counting from, say, 2014 or 2015. So there is some hope that the equity outflows are stabilizing, and we could eventually see a little bit of a recovery this year as well. In some sense, we are already seeing that in Thailand, which has a lot of, tourism-related, hospitality-related stocks in the index. And so, with the reopening optimism, that has actually really helped this inflows into Thailand. I think maybe we could see something similar for Malaysia if the domestic economy and the outlook picks up. Yeah. So with all this, it comes back down to our forecast for dollar ringgit. So with the dollar being stable or supported but not really strongly strengthening, and then also with all these fundamental views about the ringgit in terms of the trade surplus, in terms of the FDI, in terms of the potential equity inflows, and the slowdown of resident outflows, I think it's fair to say that we have this bias to see dollar ringgit slightly lower. The valuation wise, ringgit is already very undervalued at this point. So it's very hard to see, dollar ringgit pushing above 420, 425 on a sustained basis. I think the risk reward is actually really just to see dollar ringgit moving down towards 410 instead. So that's kind of our view with regards to dollar ringgit. Since I think we still have a bit of time, maybe we quickly go into RMB. So RMB has been very, very strong, not just compared to the rest of the Asian currencies, but also compared to its interest rate differential. So this gray line and black line here is the interest rate advantage of China versus the US. You can see it's rapidly fallen in the last couple of months or so. This is not just because of the US, but also because China started easing monetary policy. So PBOC, the central bank in China, is probably the only central bank in the world that is going against the grain and easing monetary policy. And so this double whammy of rising US rates, falling China rates, causing this yield differential to move very sharply towards zero. So at some point in time, we might actually reach zero. And the last time that happened was in 2019, right? Partly because of the trade war leading to downside risks in China's growth, leading to policy easing, etc. And at that time, if you recall, dollar RMB was at 690. So obviously we don't expect that to happen. You can't always map, the interest rate differential with the level of the exchange rate in itself. But I think clearly, dollar RMB at 635 is quite unsustainable and even overvalued in terms of the RMB compared to the interest rate differential. So we are expecting the RMB to depreciate. In terms of valuation, I think our idea of fair value for RMB is actually very wide, 625 to 717 or 717. But I think what's clear is that we are really at the lower end of this range. So it's very hard for it to go further down. So our view is actually for it to actually modestly rise to like something like 650 or so. And maybe finally, just finish up with Sing dollar, since I think usually there will be some questions on Sing ringgit. So Sing dollar is our favorite currency in Asia. I mean, the reason is very simple because, globally, everyone's worried about inflation, right? And Singapore's inflation is also very high. And the MAS, the central bank in Singapore, is the only central bank that directly uses the exchange rate to manage inflation. It doesn't even use interest rates. And then you have to hope for this interest rate to eventually affect FX. No, it just directly appreciates the Sing dollar to target inflation. So it's a very easy and obvious rationale for the Sing dollar to appreciate. So inflation in Singapore is the problem. So this is the Google Trends for inflation searches within Singapore itself. And you can see, obviously the last couple of weeks, the last couple of months or so, people are increasingly concerned about inflation. And that's because the headline rate in itself for inflation in Singapore reached 4%, right? And then it's probably going to rise further because if they're going to raise GST, which they are discussing, then that will add easily another 1.5% or 2% to the headline inflation rate in itself. And that's the case, and we'll actually go back to those very high inflation rates seen in 2007, 2008. So that would be quite disastrous. So anyway, we cut it. We think that the Monetary Authority of Singapore will have to continue to appreciate the Sing dollar. And so therefore, in all sorts of scenarios that we can think of, the only way for dollar Sing is down. So yeah, Sing dollar is our most high conviction call for Asian currency appreciation. This is probably an even higher conviction call than ringgit. So suffice to say that we actually still see Sing ringgit rising further this year. Yeah, maybe I'll stop here. I still have prepared some other currencies, but I just want to see what people are interested in the Q&A.